Hello everyone and welcome. I am very happy you're here with me today. In this lesson, we begin an important topic in accounting: property, plant and equipment, often called PPE. These are the long-term tangible assets that help a business operate, produce and grow over time. We will look at how these assets appear on the balance sheet, how we measure them, and how we record them correctly. Think about a machine in a factory, computers in an office, or a delivery vehicle used every day. These are not short-term purchases, they support the business for years. A common mistake is to look only at the price tag and ignore the full accounting treatment. Our goal today is to build a strong and practical understanding from the ground up. A useful tip is this: whenever you see a tangible asset that will serve the business over more than one period, ask yourself whether it should be treated as PPE. In this lesson, we will move step by step through the structure of the topic. First, we will define PPE and classify the main types of assets that belong in this category. Then, we will discuss recognition and initial measurement, meaning how to decide what should be included in the asset's cost. After that, we will review the main accounts and journal entries related to purchase, depreciation, and disposal. We will also study straight-line depreciation, including the formula, the schedule, and partial year depreciation. Later, we will discuss changes in estimates, such as useful life and residual value, and we will compare improvements with ordinary maintenance. Finally, we will work through full exercises with detailed solutions. This is important because students often understand the theory, but feel less confident when the numbers appear in an exam question. A good practical tip is to follow the topic in the same order every time. Define, measure, record, depreciate, and then review changes. Now we begin part A, where we focus on the basics of PPE and accounting recognition. This part gives us the foundation for everything that follows. Before we calculate anything, we need to understand what kind of asset we are dealing with and why it is recorded in a special way. In real life, accountants make decisions long before they post journal entries. They ask what the asset is used for, how long it will serve the business, and whether the spending should be capitalized or expensed. This is exactly why this section matters. It trains our accounting thinking, not just our calculation skills. A common mistake is to rush into journal entries before understanding the economic meaning of the transaction. A practical tip is to pause before recording anything and ask, what is the purpose of this item in the business? So, what is PPE? Property, plant and equipment is a tangible asset held by the business to generate income or support operations over time, and not for sale in the ordinary course of business. There are several key characteristics you should remember. First, the asset is used over the long term, usually for more than 1 year. Second, it creates future economic benefit, either by helping the business earn revenue or by reducing costs. Third, the asset is controlled by the business, whether through ownership or another right to use it. Fourth, because the asset is used over time, it is usually subject to wear and tear, which means depreciation is required. Think of a delivery van. The business uses it again and again to serve customers. It is not held for resale, so it belongs to PPE. A practical tip is to connect PPE with business use over time, not with physical size alone. Let us look at common examples of PPE and also at items that are usually not classified as PPE. Typical examples include buildings, leasehold installations, machinery, production equipment, furniture, office equipment, computers, information technology hardware, vehicles used in the business, leasehold improvements, and specialized medical or laboratory equipment. On the other hand, Inventory held for resale is usually not PPE because it is meant to be sold. Routine advertising and marketing costs are also not PPE. Ordinary repairs and maintenance are expenses, not assets. Very small items below a capitalization threshold may also be treated as expenses, depending on company policy. The important message here is that classification depends on purpose and use, not just the name of the item. For example, one business may treat a vehicle as PPE, while another may treat vehicles as inventory if it sells cars. A practical tip is to always ask why the business holds the asset. Now we ask an important accounting question. When do we record PPE? In practice, a business usually wants to confirm several things before recognizing an asset. It must expect future economic benefits from the asset. It must be able to measure the cost reliably, using documents such as invoices, contracts, or internal build records. And the asset should be available for use, meaning installed and ready to operate. This point is very important. Not every large payment becomes PPE. We must separate capital expenditure from revenue expenditure. If the spending only keeps the asset in its current condition, it is usually an expense. If the spending significantly increases capacity, quality, or useful life, it is usually capitalized. A common mistake is to assume that any expensive repair must become part of the asset. A practical tip is to focus on the effect of the spending, not only on its amount. Let us now discuss what goes into asset cost. Usually, the cost includes the net purchase price after trade discounts, transport costs, insurance during transit, unloading, installation, testing, professional fees directly related to the project, necessary licenses and permits, and site preparation needed to bring the asset into use. At the same time, some items are usually excluded from cost. These include staff training, routine maintenance, operating costs after the asset is ready for use, abnormal waste, and penalties caused by delays. There is also an important VAT point. If input VAT is recoverable, the asset is recorded net of VAT. If VAT is not recoverable, then VAT becomes part of the asset's cost. Think of it this way. Only costs necessary to prepare the asset itself for use are capitalized. Training prepares employees, not the machine. A useful practical tip is to ask whether the cost belongs to bringing the asset into working condition. Now we move to our first exercise on determining asset cost and preparing the journal entry. Company Alpha acquired a packaging machine. We are given a supplier price, a trade discount, transport cost, installation cost, testing materials, and staff training cost. We are also told that the business is VAT registered and can recover input VAT. The required task is to calculate the machine cost to be capitalized, identify which components are period expenses, and then record the purchase entry, including input VAT. When you face a question like this, do not try to solve everything at once. Start by separating the data into two groups: costs that belong to the asset and costs that belong to the period. A common student mistake is to include training in the asset cost just because it appears in the same list. A practical tip is to underline the phrase that tells you VAT is recoverable, because that changes the accounting treatment. Let us solve the first part of the exercise carefully. We begin by calculating the net purchase price. The supplier price is reduced by the trade discount, so we first deduct the discount and reach the net purchase amount. After that, we identify which costs increase the asset's cost. Transport, installation, and testing materials are all necessary to bring the machine into working condition, so they are capitalized. Staff training is different. Training helps employees learn how to operate the machine, but it does not prepare the machine itself. That means training is a period expense, not part of PPE. Once we add the capitalized components to the net purchase price, we reach the total PPE cost. This step teaches a very important principle. Not every cost connected to a purchase belongs in the asset account. A practical tip is to explain each item in words before deciding where it goes. Now we complete the solution by calculating input VAT and preparing the journal entry. Because input VAT is recoverable, it is recorded separately and does not become part of the machine's cost. VAT applies to the capitalized items and also to the training service, even though training is not part of the asset. In the journal entry, we debit PPE for the machine cost, debit training expense for the training amount, debit input VAT for the recoverable VAT, and credit accounts payable or cash for the total amount due. In real accounting systems, these entries are often split across several documents, such as the supplier invoice, freight invoice, and installation invoice. But for learning purposes, one combined entry is very helpful. A common mistake is to forget that VAT on an expense is still input VAT if it is recoverable. A practical tip is always to check that total debits equal total credits before moving on. We now begin part B, which focuses on straight-line accounting depreciation. This is one of the most important practical topics in fixed asset accounting, because most businesses need to allocate asset cost over time in a clear and systematic way. Straight-line depreciation is popular because it is simple, logical, and easy to apply. But students should remember that even a simple method can lead to errors if the underlying logic is not understood. In this section, we will learn why depreciation exists, what accumulated depreciation means, how the formula works, and how to deal with full year and partial year situations. A useful tip before we continue is this: depreciation is not just a formula. It is an accounting method designed to match cost with the periods that benefit from the asset. Why do we calculate depreciation, and what is accumulated depreciation? Depreciation is the systematic allocation of an asset's cost over its useful life. The purpose is to match the expense with the accounting periods that benefit from the asset's use. This is a key matching principle in accounting. It is also important to understand what depreciation is not. It is not a cash outflow, because the cash was usually paid earlier when the asset was purchased. It is also not the same as market value decline. A machine may lose value in the books even if its market price increases for some unusual reason. In the accounting records, we usually see three related accounts: the PPE asset account, accumulated depreciation as a contra asset account, and depreciation expense in profit or loss. A practical tip is to remember that accumulated depreciation grows over time, while carrying amount goes down. Before calculating depreciation, there are several concepts you must know. First is cost, meaning the capitalized amount recorded in PPE. Second is residual value, sometimes called scrap value, which is the estimated amount expected at the end of the asset's useful life. Third is useful life, meaning the period over which the business expects to use the asset. Fourth is depreciable amount, which equals cost less residual value. We also need to know when depreciation starts and when it stops. It starts when the asset is available for use, and it stops on disposal, retirement, or when carrying amount reaches residual value. Here is the logic check. By the end of the useful life, carrying amount should approach residual value, not fall below it. A common mistake is to continue depreciating beyond that point. A practical tip is to write these 6 terms in the margin before solving any depreciation question. Now let us look at the straight line depreciation formula. The straight line method spreads the depreciable amount evenly over time. Annual depreciation equals cost minus residual value divided by useful life in years. Monthly depreciation equals annual depreciation divided by 12. The key feature of this method is consistency. The depreciation expense stays the same each year or each month, as long as there is no change in estimate. This makes the method easy to operate, reconcile, and audit. It is especially suitable when the asset is used relatively evenly over time. One common exam mistake is to calculate depreciation on a gross cost that includes recoverable VAT. That is incorrect. The correct starting point is the capitalized cost recorded in PP&E. A practical tip is to box the depreciable amount first, because it is the real base of the calculation. Let us apply the formula in a full example. We use the machine cost from the earlier exercise together with a residual value and the useful life of 5 years. First, we calculate the depreciable amount by subtracting residual value from cost. Then, we divide that amount by the useful life to get annual depreciation. After that, we divide the annual figure by 12 to get monthly depreciation. Once we know the monthly amount, we can prepare the journal entry. We debit depreciation expense and credit accumulated depreciation for the same amount. This is a classic periodic entry. Notice that the asset account itself usually remains unchanged after initial recognition, while the accumulated depreciation account grows over time. A practical tip is to say the logic out loud. Cost less residual value divided by useful life, then divided by 12 if needed. A depreciation schedule is one of the most useful working papers in asset accounting. It helps us track annual depreciation, accumulated depreciation, and carrying amount year by year. In our example, the annual depreciation is constant, so each year adds the same amount to accumulated depreciation. At the same time, the carrying amount declines until it reaches the residual value at the end of the useful life. This schedule is not just an academic table. In practice, it supports financial reporting, audit work, internal control, and management review. Many businesses maintain depreciation schedules monthly or even daily, depending on their policy and systems. A common error is to build the table mechanically, without checking the final carrying amount. A practical tip is to always look at the last line first and confirm that it ends at the residual value. This visual slide helps us see the logic of straight line depreciation. Under this method, annual depreciation expense remains constant across the asset's useful life. That means each period receives the same charge. On the other hand, carrying amount declines in a straight and even line until it approaches the residual value. Visuals like this are very useful because they show the relationship between expense and carrying amount in a simple way. When students only memorize formulas, they sometimes miss the bigger picture. But when they see the line shape, they understand why the method is called straight line. In everyday business terms, the company is consuming the asset's useful service evenly over time. A practical tip is to imagine two lines in your mind, one flat for annual expense and one downward for carrying amount. In practice, assets are often purchased or put into use during the year, so we need partial year depreciation, also called pro rata depreciation. The idea is simple. We calculate depreciation only for the actual period of use. A common bookkeeping approach is to determine a constant monthly depreciation amount and multiply it by the number of months the asset was in use during the year. In the short example on the slide, the asset is placed into use in May, so depreciation for that first year is recognized only from May to December. This is an area where students often lose points because they use a full year by mistake. Pay close attention to phrases such as available for use, commissioned, or started operating. These words usually determine the start of depreciation. A practical tip is to count the months carefully and write them down before multiplying. Now we begin the second exercise, which combines straight line depreciation with the partial year situation. We continue with the same machine data from the earlier example, but now we are told the actual start of use. The required tasks are to calculate depreciation for the first year on a pro rata basis, present a depreciation schedule for the following years, and record the year-end depreciation journal entry. The hint tells us to begin with monthly depreciation, and that is exactly the right approach. Whenever an asset starts during the year, monthly thinking is usually the safest path. A common mistake is to calculate annual depreciation correctly, but then forget to adjust the first year for the actual months in use. A practical tip is to circle the start date in the question, because that single detail controls the whole answer. Let us solve the first part of exercise 2. We begin by calculating the depreciable amount, then the annual depreciation, and then the monthly depreciation. Once we know the monthly amount, the rest becomes much easier. Because the asset was used from May to December, we count 8 months of use in the first year. We then multiply the monthly depreciation by 8 to arrive at the depreciation expense for that year. After that, we record the year-end journal entry by debiting depreciation expense and crediting accumulated depreciation. This shows clearly that the business recognizes only the portion of asset cost related to the months actually used. A common mistake is to count the months incorrectly, especially when the start date is at the beginning of a month. A practical tip is to list the month names one by one to avoid accounting error. Here we see the full depreciation schedule for the partial year example. Because use begins in May of the first year, the 5-year service period does not end at the end of the 5th calendar year. Instead, it extends into the following year, and the final period includes only the remaining months needed to bring carrying amount down to residual value. This is a very realistic situation. Real business assets do not always begin on the first day of a financial year. That is why accountants need to think in terms of actual service periods, not only calendar years. The simplified annual table on the slide is excellent for learning, but many organizations keep a monthly schedule in practice. A practical tip is to check whether the final year is a full year or only a short closing period. Now we discuss changes in estimates and improvements. A change in estimate is applied prospectively. This means we do not go back and restate prior periods. Instead, we take the carrying amount at the date of change and recalculate depreciation for the future using the revised estimate. Typical changes include a revision of useful life or a change in residual value. We also need to distinguish between improvements and maintenance. An improvement that increases capacity, efficiency, or useful life is capitalized and affects future depreciation. Routine maintenance, however, simply restores the asset to its original condition, so it is expensed and does not change future depreciation. This distinction appears often in real work and in exams. A practical tip is to ask whether the spending makes the asset better than before or only keeps it running. Let us now read exercise 3 carefully. Company Beta purchased a machine with an original cost, residual value, and useful life under the straight line method. After 2 years, a significant improvement was performed. This improvement increases production capacity and extends the remaining useful life while residual value stays unchanged. The required tasks are to compute depreciation under the original data, decide whether the improvement is an expense or a capital addition, compute the new depreciation from the following year onward, and record the related journal entries. This is an excellent integrated question because it tests both classification and recalculation. Many students know how to depreciate an asset, but become confused when the estimate changes after an improvement. A practical tip is to separate the question into a before stage and an after stage. Now we complete the solution. Under the original data, we first calculate the depreciable amount and then the annual depreciation. After 2 years, we determine accumulated depreciation and the carrying amount at the end of that period. Next, we evaluate the improvement. Because it increases capacity and extends useful life, it is a capital expenditure, not a period expense. That means it is added to PP&E. From the start of the new year, we recalculate depreciation using the updated carrying amount and the revised remaining useful life, while keeping the residual value unchanged. Then we record 2 journal entries, one for the improvement itself and one for the new year's depreciation. This is a very important conclusion to remember. Past depreciation is not rewritten. We move forward from the date of change. We will stop here for today. Thank you for learning with me, and I will see you in the next lesson.